The stock market is currently closed, and the last reported closing price for SoFi Technologies, Inc. was $27.88 as of 4 p.m. Eastern Time on December 5, 2025, showing a significant drop of approximately 5.81% from the previous session's close. Now, what immediately breaks the surface here, and what every investor needs to understand beyond that simple red number, is that this entire recent plunge is not a business deterioration issue, it's a direct, textbook reaction to a massive capital markets move. The company just priced a large public offering of common stock, a $1.5 billion deal that translates to issuing around 54.55 million shares at $27.50 per share. This is the unexpected angle. The market is punishing the stock for what is arguably a prudent, strategic cash raise designed to solidify the bank's capital position and fund future growth, not for missing earnings or seeing a slowdown in customer acquisition. The common expectation among retail investors, especially those who have held SoFi for its impressive multi-year run, is that a stock this strong in its growth phase should avoid dilution. The reality is that management is viewing this from a regulatory and long-term stability standpoint, effectively trading a short-term stock price hit for a fortified balance sheet and increased flexibility. This immediately creates a tension between the growth narrative, the expectation, and the capital preservation strategy, the current reality. The general belief about SoFi is that it's the future of banking, a one-stop-shop digital financial institution successfully executing a difficult transition from a student loan refinancing shop to a full-service bank with a sticky, engaged customer base. Investors point to the soaring member and product growth, the bank charter that provides a lower cost of funding, and the technology platform, Galileo, as proof that the business model is working. The contrarian take, the deeper reality, is that this stock sale is a loud signal that the company recognizes the persistent macroeconomic pressures and the need for a stronger capital buffer, perhaps to smooth out potential bumps in their lending portfolio or to aggressively pursue further acquisitions and expansion without the stress of relying on volatile public markets later. This is a very large raise, approximately 54.55 million shares, and it came right after a period of significant price appreciation that had taken the stock near its 52-week high of $32.73. The timing, capitalizing on strength, is smart business, but the immediate effect is to lower the per-share value of existing holdings, which is why the volume spiked and the price cratered instantly. The question for the smart friend over coffee is whether the trade-off, short-term pain for long-term balance sheet health, is worth it. Right now, the market is voting no on the short-term dilution, but the underlying operational strength remains the true argument for holding the stock. Looking closely at the recent stock movement, the reaction to the third quarter 2025 earnings report was actually very positive. The company crushed expectations, reporting EPS of 11 cents versus a forecasted 8 cents, and revenue of $961.6 million, significantly higher than the $887.24 million consensus. This demonstrated the power of their model, specifically the accelerating growth in the financial services segment and the stable performance of the lending segment, even in a high-interest rate environment. Following that report, the stock saw a strong lift, establishing a clear uptrend that led directly to the recent highs. The institutional activity was also very telling in that period, with several large money managers either increasing their positions or initiating new ones, seeing the company as one of the few high-growth fintech names that had achieved GAAP profitability and possessed a full bank charter. The volume surge accompanying the recent decline, however, suggests a high-velocity rotation of capital, likely from institutional traders and short-term holders looking to lock in profits from the prior rally and avoid the immediate overhang of the increased share count. The massive $1.5 billion raise is now the primary headwind, a heavy weight that will require significant time and positive news to overcome as the market digests the new supply of shares. This brings us to the crucial discussion of short-selling awareness and the active forces currently pressuring the stock. SoFi has historically been a popular target for short sellers due to its high-growth valuation and its exposure to the lending market, which many bearish analysts believe is poised for stress, particularly in the personal loan and student loan categories. The latest official Nasdaq short interest data, which typically lags, shows a substantial short position, reporting over 116 million shares short as of the mid-November settlement date. This represents a short interest percentage of the float of approximately 9.80%, a high but not immediately catastrophic figure. Crucially, the days to cover figure, which is a measure of how many days it would take for short sellers to buy back all borrowed shares based on average trading volume, stands at around 2.74 days. A number above 5 is often considered high and a sign of potential squeeze fuel, so 2.74 is relatively neutral, suggesting that while the short base is large in absolute numbers, it could cover without a massive market disruption if a catalyst appeared. However, the recent stock offering changes the short thesis immediately. Short sellers who were betting on the company running into capital issues or needing to raise capital at a distressed price just got an answer. While the dilution is negative for current shareholders, the capital raise itself makes the short thesis of SoFi will run out of cash or they will need to raise at a low price significantly less credible in the near term. This $1.5 billion provides a powerful buffer. The key actionable insight here for retail investors is to watch the borrow fee rate. The current borrow fee for SoFi is still very low, hovering around 0.29%, which indicates that there is plenty of supply of shares to borrow, and that short sellers are not yet experiencing the pressure of a rising cost to maintain their positions. If the borrow rate were to spike to 5%, 10%, or higher, that would signal a tightening supply and an increased risk of a short squeeze. What we are seeing is classic short behavior. The initial sell-off from the stock offering may have been amplified by short sellers piling on to pressure the price further and cover their existing positions at lower prices. The fail-to-deliver data, which tracks trades where one party fails to deliver the securities, has shown some minor spikes in November, but nothing that indicates a systemic problem. Retail investors should monitor the next official short interest update later this month. A sharp drop in the short interest would suggest a wave of covering after the capital raise news, while a significant increase would signal bearish conviction remains strong. The core business model of SoFi Technologies centered on its mission to help members get their money right by offering a wide array of financial products delivered through a modern, unified digital platform. This isn't just a lending company anymore. It's a full-fledged bank holding company. Their revenue is split across three main segments: the lending segment, which includes student loan refinancing, personal loans, and home loans; the technology platform, driven by Galileo, which provides core processing services to other fintechs and traditional financial institutions; and the financial services segment, which encompasses their checking and savings accounts, credit cards, and investment products. The shift over the past year has been towards the latter two, which are less capital-intensive and less interest rate sensitive. The Q3 report confirmed this transition, showing that the technology platform and financial services were contributing significantly to the overall revenue. The bank charter, acquired in 2022, is the anchor, allowing them to fund their loans with low-cost member deposits rather than more expensive external capital. This bank component is the real edge over other consumer fintechs, and it's what institutional investors are ultimately betting on. The future outlook for SoFi is fundamentally tied to two key elements: successfully integrating and monetizing the rapidly growing member base and navigating the shifting interest rate environment. The expectation is that as the Fed begins to signal rate cuts, the lending segment, particularly student loan refinancing, will see a significant tailwind. The reality, however, is that the timing of those cuts is uncertain, and until then, the company must continue to prove its ability to control credit risk in its personal loan portfolio while scaling up its deposit base to keep funding costs low. The immediate catalyst or risk is the fallout from the stock offering. Management has stated the proceeds are for general corporate purposes, including enhancing the capital position and funding growth. This vague language invites speculation. The opportunity is that this capital raise, while painful now, provides the war chest needed to achieve their long-term goal of being a top-tier financial institution that competes directly with the major money center banks, but with a digital-first cost structure. If they execute their growth plans efficiently with this new capital, the dilution will look like a minor footnote a year from now. If, however, the growth stalls or credit losses tick up, the new shares will feel like dead weight. The focus must be on the next earnings report, specifically watching the growth rate